telling the funds that they have 3 days to wind up the positions. Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics, and wanted to provide an update tonight about what's going on in the United Kingdom government bond market, where things are happening quickly. Recording here on Tuesday night, and the latest news that has come out is an announcement from Andrew Bailey, the head of the Bank of England, telling the funds that they have 3 days to wind up the positions. And these are the pension funds that have positions that were getting hammered pretty good to about just over 2 weeks ago when the yields started spiking. Again, take a look at the chart. You can see the yields on British government debt was spiking higher, which was causing some collateral margin calls for some of these funds. And a lot has happened already this week. On Monday, they increased the size of the amount of bonds that the Bank of England can purchase, because Andrew Bailey responded by saying that they were going to start purchasing British government bonds, or as they're known as gilts. And they're also raising rates in efforts to fight inflation. So this move 2 weeks ago actually had the effect here of bringing the yields down temporarily, although they have spiked again in the last couple of days and earlier this week. So a lot of confusion going on out there, and a lot of calls for the Bank of England to continue buying the bonds. Yet Bank of England Governor Andrew Bailey warned fund managers they have until the end of this week to wind up positions that they can't maintain before the central bank halts its market support. So at least for the moment, he's saying that come Friday, that is going to be it. Now, in response to this message today, pound fell below 110 versus the dollar for the first time since September 29th. And U.S. stocks were also down a bit. The other announcement was earlier today that the Bank of England expanded the range of bonds that it was able to buy, including inflation-linked debt, which was part of the flare-up. Although, again, you can see a comment from an analyst, we think markets will force the bank's hand to either extend these measures or open new ones into mid-November, when, again, they are currently scheduled to begin quantitative tightening. 2 weeks is not enough. More needs to be done. Pension funds are taking steps to address their liquidity, but are chasing moving targets as yields have continued to rise. So not a good situation, certainly for such an established bond market as the United Kingdom. And again, here you can see at the heart of this is something called a liability-driven investment. And to get a better idea of what that is, we'll take a look over here. It's a strategy used by pension funds to manage their assets to ensure they can meet liabilities, thus the name. Strategy often involves derivatives, interest rate swaps, and other contracts that allow them to hedge their bets in the case that the market moves against them. To arrange them, the funds have to put up some collateral for the trade. If yield falls, they make money, and if yields rise, they typically face a margin call and have to pay more. But the issue was that there was such a big move, again, as you can see here, really started in August. Let's see what the yield was down there at approximately 1.81%. And then by September 19th, 2.26%. And then really skyrocketing in the back half of September, getting up to 4.49%. So quite a big move, which was causing problems. And what caused the blow up? Well, pension funds and investment managers have liquid assets and cash they can use to top their collateral when yields rise. They usually have several days or weeks to make the payments, but in the past few days, yields rose so sharply, managers had to come up with cash in a number of hours. And many pension funds didn't have enough spare cash to meet the margin calls. So they went to selling the government bonds. And a lot of these funds, according to Bloomberg, are holding the inflation-linked bonds, which are the ones that were included in the bond buying program this morning on Tuesday, again, as I'm recording this, Tuesday, October 11th. So they pushed yields higher, which in turn increased the collateral payments they had to make. Bank of England stepped in to stop the cycle. And why does it matter? The move triggered the largest fall on record for British debt only a day after their biggest ever spike. And where does this leave the Bank of England? In an odd position? On one hand, it's trying to slow down the economy and inflation, yet now is buying more bonds, putting more cash into the system. So, really a difficult position. Again, a lot of this has started back when the Federal Reserve started raising interest rates, a lot of the other central banks raising interest rates as well, although, as many had thought might be the case, run into trouble, especially as the rates go up, borrowing costs going up, and causing problems in the market. So, take a quick look over at the British pound. Again, you can see here, interestingly, pound actually spiked up after they made the announcement to buy more government debt. Although, as they've been purchasing it, the pound back down to $1.09. So, not easy times in the British government bond market. But again, the key news today that came out this afternoon is that, at least for now, Andrew Bailey is saying they have 3 days to wind things up and they are going to stop purchasing the bonds. Whether they actually do their quantitative tightening at the end of the month seemingly would be difficult to do. But as of now, Bank of England giving 3 more days and then allegedly going to stop the current quantitative easing program. We'll have plenty of more coverage of this on the show. I actually recorded an interview with Rafi and also Michael Oliver, 2 separate interviews this morning. That will be coming your way on Wednesday and Thursday, where we dig into that, amongst a lot of other things, of course, including the silver market. So, with that said, going to wrap up for here, but just wanted to pass this along. Hope you're having a great night out there and staying safe. Appreciate you being here as always, and I will see you again tomorrow.